I've been following a growth stock that's down 89% off its high watermark. The reason why I'm bringing this to your attention because I think it's undervalued. I'm going to share with you the reasons why I believe that's the case. The arguments will center around the company's very attractive business model. I'll also touch on its revenue growth, cash flow expansion, and its massive total addressable market opportunity. Also, I'll touch on analyst expectations for its earnings growth, and of course, I'll finish with its valuation to determine why I like this stock and why I think it's an excellent undervalued growth stock to consider adding to your portfolios at current prices. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, the growth stock that I'm bringing to your attention today is Snap. It's trading at $9.41 per share. That's down almost 90% off its high. It was previously trading closer to $80 per share. Of course, I wasn't recommending it as a buy at those higher valuations, but here in 2024 at the lower valuations, I've been recommending this stock as a buy. One of the reasons why I like Snap is because of the impressive revenue growth over recent years. It now has $4.98 billion in trailing 12-month revenue. That's up from less than $500 million in 2017. Of course, Snap operates in the massive advertising industry. In 2024, ad spending is expected to reach $1.077 billion, and that's increasing by 6.3% from the same time last year. Now, one of the more interesting things about the advertising industry is not only massive at over $1 trillion in worldwide spending, but it's also undergoing a dramatic shift within the industry where advertisers are shifting their spending from non-digital formats to more digital formats like Snap and like Alphabet and Facebook and Meta platforms because it's just more convenient and more measurable. You can precisely determine how many people clicked your advertisement and purchased the product. And then as a marketer, you can decide how much you're willing to spend if you know how much revenue is being driven by those advertisements. Compare that to making a commercial during a cable TV program. You don't know how many people saw it. You don't know how many people went on and bought something after they saw it. There's a lot of imprecise measurements you can use to try and triangulate the potential impact of that spending, but it's not as precise as digital spending where you can measure exactly how many people clicked and how many people purchased. And so that measurable return on investment creates great demand from marketers worldwide that can tell precisely what's happening. And so that's driving spending for the industry, and Snap is benefiting as a result, as you can tell, by its excellent revenue growth over recent years. Also, the company's cash flow from operations is improving very nicely here. Let me make this more visible. And you can see $244 million in trailing 12-month cash flow from operations. That's up from negative $800 million in 2018. And I highlighted at the top of the video, I would discuss the very favorable business model. And Snap has this very favorable business model where the content on the platform is user-generated, user-created, and that means close to zero cost for Snap. People on the Snap platform are creating the content that's bringing engagement, and that benefits Snap as a company. It just needs to invest in the technology to make sure the app has features that attract people to go on the platform, stay on the platform, make posts on the platform, and Snap will benefit from that user-generated content. Other companies with similar business models are YouTube, which you're probably watching this video on. It's a great business model because I'm making this content for YouTube, and YouTube will benefit from my creation, right? They only pay me if my creations generate revenue. And it's the similar model for Snap. Instagram is the same way. People create content on Instagram, and Meta Platforms benefits from that. And you can see the lucrative profit margins at scale this business model can generate. At scale is the key. And Snap has already reached hundreds of millions of daily active users, and it's generated this much cash flow from operations. If it can continue growing, which it has been, it will only incrementally add to the bottom line because the bulk of those investments in the platform are already accounted for. So the incremental revenue will flow more passively to the bottom line, right? The analysts on Wall Street that are following Snap over the next 5 years, they think Snap will increase its earnings per share by 63.8% each year over the next 5 years. Now, I think that rate of increase might be a little high, but even if I cut this in half and I say it's going to grow its earnings per share at 30% each year over the next 5 years, it would make for a lucrative investment. It would still be undervalued, even if it's growing its EPS at half of what analysts expect. Now, if it grows anywhere near what analysts are expecting, then this stock is a bargain. This stock is an absolute steal at current valuations if it's going to grow its earnings per share at this rate over the next 5 years. And that's because at the discounted valuation, at the discounted price at less than $10 per share, Snap is trading at a forward PE of 25.8. Now, that's cheap when compared with the earnings per share expectations, the built-up network effects that the company has built with the hundreds of millions of daily active users, the technology investments Snap has made, the industry that it's operating in with a massive total addressable market opportunity, and it's less than half of the EPS expected. Remember the general rule of thumb I talk about with EPS expectations? When the EPS here at close to 64 is larger than the forward PE, the general rule of thumb is that you're getting a good deal. So if the forward PE is 25, if the EPS here is anything at 25 or above, then you're getting a good deal. Well, with Snap, it's 63. So analysts are expecting 63% growth or 64% growth, and you're paying just a forward PE of 25. Now, that in itself wouldn't be enough to make an investment decision, but in combination with the other factors I mentioned, the attractive business model with user-generated content at the core, and the massive total addressable market opportunity, and the sustainable cash flow from operations, all come together to make Snap an attractive investment. It's no surprise then that I've had Snap rated as one of my top stocks to buy here in 2024. And I'm reiterating that recommendation here in this video, highlighting that Snap is one beaten down growth stock that is undervalued for long-term investors. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.